Important life insurance article you'll ever read. I'm just telling you right now, my friends, I'm going to read it to you. So get your seatbelt on because this is going to be fascinating. And for someone who's got as much years of experience as I do, I cannot tell you how much info I've learned from this article that I'm going to share with you today on life insurance. And you're going to learn a lot as well. And so I'll share the link with you in this so you can refer back to it because, man, it is fantastic. So stay with me, my friends, because this is going to be one for the ages when it comes to your understanding of life insurance. So thanks for coming to the Heritage Wealth Planning YouTube channel, my friends, the place you come to learn all about life insurance, tax strategies, financial planning, retirement planning, taxes, you name it. If that's your cup of tea, then you, my friends, are in the right place. So don't forget to subscribe down below. And of course, if you subscribe, hit the little bell. That little bell notifies you of future content. Like I'm going to be going live here in about an hour and 45 minutes. And only people who subscribe got that info about my live Q&A session. So you don't want to do that too. So let's dive right into it. I'm going to just show you first and foremost. This is Michael Kitces, and I've been following Kitces for a long time. The dude's a machine when it comes to financial planning research, as there's very, very few people better. You're just more. I don't think he's human, frankly. But I know he's got kids, and I follow Kitces a lot. I met him a couple times. Good guy. Nice guy from my neck of the woods in the DC area for sure. So he actually has this thing called Nerd's Eye View. And I'm just telling you, the stuff that's on here is just outstanding. And if you're into financial planning and you're not reading Kitces, then you're missing out. There's no other way around that. Everything Kitces writes, I read, is because it's literally head and shoulders above 99.99999% of everybody else out there. Just no getting around that. Now, in this case, on his blog at kitces.com, in this article right here, he didn't write it. This guy, what's his name? Rajiv Rebello wrote this article. And here's Rajiv, which is what we're going to go over today. But if it's on Kitces' blog, it's detailed and it's precise and it's been well documented. So we're just going to dive into it because this is, just fantastic. The title is Universal Life Insurance Funding Strategies, Optimizing Death Benefit versus Cash Surrender Value Internal Rate of Returns, IRRs, Internal Rate of Returns. It sounds boring? Don't. I'm just telling you, man. I know that sounds boring. I know life insurance is evil. I'm telling you, don't do that. That's what I used to think too. And you're wrong. No other way around that. Does that mean you need to get cash value life insurance? No, of course not. Does it mean it's inherently evil? No, of course not. Could there be strategies that you can use to maximize your benefits for death benefit, i.e. when you leave this world, you're going to leave something to somebody, or for your own cash level in terms of your ability to draw from it later on in retirement? The answers are yes and yes, as long as you know how to play the policy correctly. So let's just go. I cut and paste this in or a Google Doc simply because I want to be able to kind of take some notes while I'm reading this. We'll see. I might divide this up in 2 episodes. We'll see. But the first thing, let's go over here. A brief history of permanent life insurance. Prior to the introduction of universal life insurance in the early 80s, the only permanent insurance available to policy owners was whole life insurance, which required a policy owner to pay a fixed given amount of premium each year in exchange for having a fixed given death benefit and a progression of fixed cash surrender values over time, all of which were guaranteed. The result was that a policy that gave a quote-unquote reasonable rate of return on the cash value and a quote reasonable unquote internal rate of return, IRR, internal rate of returns, IRR, for those that held the policy until death. Unfortunately, though, by trying to give clients a return on both these elements, the death benefit and the cash value, the implied returns were a lot lower for either than what could be achieved by focusing individually on just one element or the other. And again, that's a drawback. The jack of all trades, the master of none. When we're trying to be all things to everybody, we usually are less beneficial than just focusing on one. And that's what the older life insurance days of whole life used to be. In this context, the significance of the introduction of more flexible premium ULs, universal life products, was that it gave policy owners the flexibility to more fully maximize either the IRR on the death benefit portion of the product or the investment return on the investment account in the product, the cash surrender value, above and beyond what traditional whole life could do with either, simply by structuring the product and premiums paid into the policy differently. The caveat, however, was that because of the complexity of the universal life insurance, most policy owners and their financial advisors We're not, and are still not, fully aware on how to properly utilize the flexible UL products to fully optimize one of these financial goals. Again, the financial goals are two competing things, frankly. Internal rate of return, your rate of return on your cash surrender value, the money that you can access while you're alive, and the internal rate of return on your death benefit, the money you leave to your heirs. So two competing things. You increase the rate of return on one, you're inherently decreasing the rate of return on the other. So your fundamental thing is, what do you want to accomplish? Increasing the value of the death benefit relative to the amount of premiums you pay, or increasing the value of the cash value relative to the amount of premiums you pay. Two competing differences there. And unfortunately, I guarantee the vast majority of financial advisors have no clue. None. I know that for a fact, and I know that because I'm one of them. I have enough of a clue to know I have no clue, which is scary in of itself because I consider myself pretty smart on this stuff. But even on these kind of issues, my friends, man, I tell you what. Accordingly, this article will take a given sample universal life product and show how it may structure differently depending on whether the client is looking to maximize the IR and the death benefit or the cash surrender value. So just DB, death benefit, CSV is cash surrender value. Just remember the death benefit is the amount of life insurance that pays out at your death. The cash surrender value is how much you could tap into it while you're still alive. But in order to understand the dynamics at play, it is important to understand on a high level the main cost of insurance expenses that are deducted from a universal policy in the first place. Man, I could not agree with that more. And this is where I learned a lot here just reading this article, and you're going to too. What are the cost of insurance, the COI charges? The cost of insurance charge is the main expense that is deducted from a universal life policy each year to compensate the insurance company for the actual risk of needing to pay a death benefit when the insured dies. Other expenses charged by insurance companies include premium loads, monthly policy charges, and surrender charges, which will be discussed later in this article. There are two main components to this cost of insurance charge. The COI rate is the cost of insurance rate, and the net as amount at risk, the NAR. So the cost of insurance is all encompassing of the cost of insurance rate and the net amount at risk. So you got to remember that the cost of insurance is just overlooking, and there's two things that flow up to it: the COI rate and the net amount at risk. The cost of insurance rate accounts for the risk, i.e. the probability that the insured dies in any given year, since the insurance company would have to pay the death benefit. Not surprisingly, the COI rate increases each year as the insured gets older and has a higher chance of dying. All right, that's not rocket science there. The cost of insurance rate, not the cost of insurance charge necessarily, we'll talk about that, but the cost of insurance rate increases each year because you're more likely to die. Crazy, right? The net amount at risk reflects the amount of actual dollars at risk for the insurance company if the death benefit needs to be paid. Since the insurance company already has a certain amount of cash value on hand associated with the policy to apply towards the death benefit, the true amount at risk is only the difference between the death benefit and the amount of cash that's already accumulated. I cannot stress that enough. I cannot tell you how many people don't understand that. And a lot of professionals too. You have a death benefit of $100,000. You have a $500,000 in cash. That means the net amount at risk to the insurance company is $500,000. If you died today, your spouse would get $1 million. 500,000 of yours and 500,000 of the insurance company. That means the insurance company net amount at risk is inherently $500,000. Accordingly, the full charge for the cost of insurance is a combination of the COI rate for a potential amount of risk, i.e. how old do you get, and that's typically quoted as a cost per $1,000 of insurance, multiplied by the actual net amount at risk that the insurance company is providing coverage for. And here we'll see a graph. Cost of insurance charge per year equals the cost of insurance rate per year times the net amount at risk per year. All right, so what we're showing in this graph, if you listen on the podcast, I'll show you. Basically, your cost of insurance rate at 55 years old is like, I don't know, $2 for every $1,000. And it's so low I can't even see it. But, well, actually, they'll show us right here. They talk to us. As you can see above, the cost of insurance rate as the insured gets older. The cost of insurance rate increases as the insured gets older, Thus, while at age 75, there's only 11 out of 1,000 chance, and you can see here, he's 75 years old, and here's the chance of death. So 75 years old, chance of death, we go over here, is right at 11. So at the age of 75, there's only 11 out of 1,000 chance, 1.1% of the insured dying in that year. At age 95, there's a 63% chance. Here's 95. We go up here, and you can see we are at 63% chance, which is a 6.3% cost of insurance rate. So at 75, 11 out of 1,000 die. 11 into 1,000 or 11 divided by 1,000 is a 1.1 cost of insurance rate, 1.1% on the $1,000 of insurance. At 95, there's a 6.3% chance of dying. So it's going to be 6.3% on the $1,000 net cost of insurance. All right, well, I'll explain it better here. Since the total cost of insurance charge is a product of the COI rate multiplied by the NAR, the only way to keep the cost of insurance charges low in the later years is to make sure the product is well funded so that the net amount at risk is low. And I'm going to show you, if you're on the podcast, you won't see this, but I cannot tell you how important this is. So we're showing you a graph here, as indicated in the graphic above, paying a level premium to endow the policy, all right, i.e. the endowment means have the account value equal the death benefit at age 100, results in the account value increasing each year. So basically what's happening here, you can't see this, we got a $5 million death benefit. And when you took the policy out at 50 years old, you don't have any cash value in there. So your net amount at risk is $5 million. Each and every year, though, you're paying this level premium. So that way, when you hit 100, your cash is 100% equal to your death benefit. And that means it's endowed. Your cash value equals your death benefit at 100. So what's happening here is the net amount at risk is decreasing because you're putting more and more money into it when you're younger, and then it's starting to grow and grow and grow. The cash is growing and growing and growing. So the net amount at risk to the insurance company is decreasing, but your cost of insurance rate is increasing because you're getting older and more likely to die. And because the COI rate is going up and the net amount of risk is going down, they offset each other. So you have a flat level premium that the insurance company knows for a fact. If you pay this premium, we know that you will be guaranteed at 100, you have enough cash to cover the death benefit, and there won't be any net amount at risk to the insurance company, which inherently means there's no cost of insurance because there's no insurance that they're going to cover you. And at your death at 100, your spouse will just get the $5 million. All right. As the account increases, the difference between the death benefit and the account value, the net amount at risk, decreases in turn. Policies that max fund the policy and reduce the NAR in later years effectively reduce the cost of insurance charge in the later years as well, even though the actual cost of insurance rate is increasing in those later years. So again, going back to the graph here, the net amount at risk is declining, but which means the NAR charge to you, the cost of the insurance company, is declining as well because their risk is losing, which is actually going to have a little bit of an offset to the increasing cost of insurance rates because you're getting older. The significance for the formula of COI charges is that while the COI rate increases as the insured gets older, having a reduced NAR, net amount at risk, in the later years can offset this increase in COI rates and actually result in lower overall cost of insurance charges than when the insurance was younger. That's confusing as all can be, but you think about it. I'm getting older, but the insurance company has less risk. That's all there is to it. Less risk to the insurance company inherently means they have less that they have to charge me to cover that risk. And that risk is getting lower and lower for the insurance company. The cost of insurance is actually reducing because even though I get older, that amount is actually growing at a lower pace than the amount the less of the insurance company is losing at risk. It's confusing, but I think you can get that. At the end of the day, regardless of what happens, if your net amount at risk grows equal to which decreases, your net amount at risk decreases to the insurance company equal to a rate of your cost of insurance rate increasing, there will be no more risk or no more cost of insurance rates or cost of insurance charges to you because the two things offset. So that's probably a better way to look at it. All right, let's look at the difference in charges for a policy owner who has minimally funded their life insurance with a policy owner who has max funded it. And now what we're going to say here is we got a maximum funded policy owner. Policy owner has paid the maximum premium, the max premium each year for 30 years into a $5 million death benefit, such that the policy now has $3 million in account value. The cost of insurance rate is 2%. So a COI rate of 2% means it costs $20 of insurance charges for every $1,000 at risk. Minimum funded policy owner. Policy owner has paid the minimum into the policy each year at a $5 million death benefit. As a result, the policy owner only has $10,000 in cash value. The cost of insurance rate is the same, 2%. Again, the cost of insurance rate is $20 per every $1,000 at risk. Now, before we go into the details, remember, the maximum funded has $3 million of cash in his account, which means the insurance company only has $2 million at risk. The minimum funded only has $10,000 in cash value in this account, which means the insurance company has $4.99 million at risk. And so what we figure out for the cost of insurance charge is we take the 2% times the difference in the net, or times the net amount of risk. In the first case, is $2 million is the net amount of risk. And then that is $40,000 is a cost of insurance charge, because we have $2 million at risk and the cost of insurance rate is 2%. And that's how that works. Now, the second case where the minimum funded still have the 2% cost of insurance charge, but because we have 4.9 something million at risk times the 2% times the 4.9 million at risk and then amount at risk, and we have a $98,000 cost of insurance charge. From the example above, we can clearly see the dilemma at hand. While the minimum funded policy owner may have saved the premiums up to that point by minimally funding the policy, going forward, that policy owner will pay drastically higher cost of insurance charges that will result in significantly higher premiums being owed on the policy going forward than their maximum funded counterpart, even though the cost of insurance rates are the same. I'm 75, you're 75. Two costs of insurance are identical, 2%. No getting around that unless I smoke and you don't. But other than that, and if we're just the same we got Josh and Ben, that's my brother. So let's say we're twins. We're not, but just say we are. We have the exact same cost of insurance rates, 2%. But he has $4 million in his account value. I have $10,000. My cost of insurance charges will be substantially higher because he has less at risk to the insurance company. It's worth recognizing that this isn't always bad for the minimum funded policy owner, due to the extent that these two types of policy owners typically have very different goals in place. Man, I could not stress that more. The minimum funded policy owner is usually trying to minimize the premiums that have to be paid into the policy in order to maximize the internal rate of return on the death benefit itself. Now, this is where you need to stay with me. I'm just telling you right here. If you just look at the other chart here, and you say the guy with $3 million in cash is only paying $40,000 for his cost of insurance charge. The guy with $10,000 in cash is paying $98,000 for his cost of insurance charge. And if your default is that you want to be the guy with $3 million in cash, hang tight. We're going to show you why that's not necessarily the case. In fact, more often than not, won't be. The maximum funded policy owner in comparison is usually trying to maximize the cash value and his tax-deferred growth benefits, while paradoxically involves maximizing premiums paid into the policy in order to minimize the cost of insurance costs that needs to be paid. In other words, a minimum funded policy owner wants to maximize the internal rate of return on the death benefit. That's what we're trying to do. If you're minimizing if you're minimum funding the policy amount, so I'm not putting that much in the beginning of when I took the policy out. So you got to understand, what is the optimal way to pay for the least amount into the insurance policy to get the death benefit? Recognizing that cost of insurance charges will rise over time. That's what the minimum funded policy is trying to do. I'm trying to put the least amount in today and in the future to maximize the death benefit internal rate of return. On the other hand, the maximum funded policy owner is asking a very different question. What is the best way to structure the policy in order to achieve a maximum tax-deferred growth of the cash value itself? Recognizing that the cash value reduces the NAR, the net amount at risk to the insurance company, and will also decrease the cost of insurance. Huge. Two different scenarios. I want to minimize the cash going in to maximize the death benefit, but that'll only pay out when I die. So that may or may not be something you want to do. If it is, you don't fund this puppy very heavily on the front end. On the other hand, I want to maximize the cash available to me in the future, which means I put a lot more money in on the front end because I want to have access to it. So you got to understand when you're using life insurance, what is it we're trying to solve here? All right, maximizing the IRR. Let's see how long. Let's go back to part 2 here. So we're going to take a break. It'll go back to part 2. We're going to talk about maximizing the internal rate of return on insurance policy death benefit. And then we're going to go to part 3, maximizing the internal rate of return on insurance policies cash value. So we'll split this up into 2 things. So remember, as you close out here today, remember, what are you trying to accomplish? So we want to maximize the IRR, the internal rate of return on the death benefit, the amount that pays out to my heirs at my death. Or we're trying to maximize the IRR on the cash value, the amount that I can access to while I'm alive. That's what you got to think about. So stay tuned. We'll see you next time here at the Heritage Wealth Planning YouTube channel.